So, hello everyone, and I hope everyone is well. So I got to apologize. I made a mistake. I had two classes and both had the last course, the last chapter was chapter 18, and I accidentally sent chapter 18 from my 545 class to you. So I deleted that, and you might be going crazy trying to figure out what that's all about. But the chapter 18 we should be talking about right now is capital budgeting, okay? And this is the last chapter we'll cover. Okay, so this is capital budgeting and evaluation, and we're going to make a couple of assumptions here. And the obvious assumptions are that the project has average risk, however you want to define that, and the debt to equity ratio is going to be constant, and there's only going to be corporate taxes as far as imperfections to the model. Okay. So this constant debt equity ratio and the weighted average cost of capital, this is going to be constant, and the weighted average cost of capital is going to remain constant over time. Okay. And here's our equation, and this is an important equation for our weighted average cost of capital. Okay. And so this is the equity over the a total valuation, right? And this is your return on equity here. And this is debt to the total valuation. And this is your return on a debt. And you can see here the corporate taxes are involved here. Okay, so this is leveraged. Okay. So we're going to value a project here by the, or even a corporation, by the weighted average cost of capital method. And here's how we determine the weighted average cost of capital. It's weighted by how much equity we have and how much debt we have. Okay. So you can see here the valuation of the project, okay, or the investment, is going to be, first of all, it's leveraged. You see that L? It's leveraged. And it's going to be a function of the free cash flows associated with this, divided by the weighted average cost of capital that we calculated up here. Okay. So this is equation 18.2 in your book. So this is now again, these are expected free cash flows, okay, of an investment. And you can see, and again, this is all leveraged. I got to shut my phone off. Hold on a second. So this weighted average cost of capital method is nice to do with an example. And this comes right out of your book here. So this company is going to introduce a new line of packaging. So they expect the technology used in these products to become obsolete after 4 years. However, they expect annual sales of $60 million per year, right, for 4 years. And there's your cash flows. So the manufacturing costs and operating expenses are expected to be $25 and $9 million respectively. So here's the costs and here's the operating expenses. Okay, so developing the product is going to require R&D, right? And these are the expenses for R&D, together with a $24 million initial investment in equipment. The equipment is going to be obsolete in 4 years and will be depreciated using the straight line method of depreciation. They don't expect any net working capital for the project, and here's their corporate tax rate. Okay, so here is the incremental earnings forecast. Okay, so you got to be careful here. There's a small income statement right here, and then here's the free cash flows. Okay, and here's how we're determining the free cash flows. Okay, so you can see this is unlevered now. This is unlevered. You notice there's no debt here, right? So we're unlevered. So here's the sales. Here's the cost of goods sold, as they told you, which gives us the gross profit. Here's the operating expenses. Okay, and here's the depreciation. Again, all this has been given, right? So we determined the earnings before interest and taxes. Okay, here's the income taxes, right? At 25%. Okay. So again, this is unlevered because there's no interest on debt, right? So we have that. And now we have, now you'll notice how the depreciation is lowers your taxes here, right? You see how the depreciation is being used twice? It lowers your taxes, but then as far as cash flow, it's being put back on to increase your cash flow. Okay, so here's your capital expenditures that were given, and here's your cash flows. So here's your net income, but they include the depreciation back on. So here's your unlevered net income, which is negative, and this is negative. So you have a negative cash flow in the beginning, right? And then you add the 15 million and the 6 million up, and you get 21 million for your free cash flows. So this is how we determine our free cash flows, okay, from their project. All right, so here's the balance sheet, all right? So here's the balance sheet. They have 20 million in cash and 600 million in existing assets. So here's their total assets, and that's got to equal the total liabilities and equity, right? Which was what we have here. So here's the total liabilities and equity. So here's their balance sheet, right? So small balance sheet. So all this is given to you in basically table 18.2 in your book, right? Okay, so what they're trying to determine is the levered value of this project, okay? All right, so Avco intends to maintain a similar debt-equity ratio for the foreseeable future, including any financing related to the project. So their weighted average cost of capital, okay, is going to be, here's the equity, all right? Here's the debt. Now, the equity plus the debt, okay? Now, you'll notice the debt in your book is 320, but there's $20 million in cash. So that makes this bottom line 600 million. They took off the cash. Oh, so it's right here, right? They took off the cash. So the equity plus the debt is 600 million, right? So here's the equity, here's the debt, and here's your return on equity and return on debt that's given, and here's your corporate tax rate. So your weighted average cost of capital comes out to 7.25%. So once we got that, now we're almost home free. So here's the cash flows, right? Here's the cash flows, right? 18 million, right? That was given to you in the example. And here is the 7.25%. So you get the levered value of this project, and it comes out to be 70.73 million. So here's the value of the project. And that includes that tax shield, right, as we said. So we get the present value of the future cash flows. However, we got to get the net present value of this project here. So it works out that when you subtract off the 29 million from the, now this should be 70.73 million. You see that right there? Let me make everything consistent. Let me make everything. And by the way, there was an error in the previous slide, and I fixed that, right? And I fixed that right there. Let me fix this. I guess it won't let me fix this. All right, let me cancel. So this should be 70.73 million. And let me just put a note here. Fixed error. And I'll highlight that, okay? There's an error in that slide. All right, so the summary of that weighted average cost of capital method that we just did is right here. We determine the free cash flows. We compute the weighted average cost of capital, And we compute the value of the investment, including the tax benefit of leverage, by discounting the free cash flow of the investment using the weighted average cost of capital. So that's what we did in those previous slides with that example. Okay, so that's what we did there. And again, there was an error. So here's another example of the weighted average cost of capital method here. This is one of 3 methods we're going to be doing. So suppose Avco is considering the acquisition of another company in its industry, and that specializes in custom packaging. The acquisition is expected to increase Avco's free cash flow by $4.25 million the first year, and this contribution is expected to grow at a rate of 3% per year from then on. Now, the secret here is the word 3% from then on. That makes this look like a perpetuity, right? Avco has negotiated a purchase price of $80 million. After the transaction, Avco will adjust its capital structure to maintain its current debt-equity ratio. If the acquisition has similar risk to the rest of Avco, and this should say Avco, what is the value of this deal? So we would do the similar items that we did for the previous example, except it's going to be a perpetuity, right? So the free cash flows can be valued as and again, here it is. It's a growing perpetuity, right? It's a growing perpetuity. Because its risk matches the risk for the rest of Avco, and because Avco will maintain the same debt-equity ratio going forward, we can discount these cash flows using the weighted average cost of capital that we previously had for the other problem, right? So we're going to reuse that. So thus, that's how simple this problem is. So the value of the acquisition is, here's the cash flows, and here is the weighted average cost of capital from the previous example. Here's the growth rate. So given the purchase price of $80 million, the net present value is 100, right? Minus $80 million, and becomes, it's $20 million, all right? Because they gave you an $80 million purchase price in the previous slide. Okay. So because they're maintaining a constant debt equity ratio, you remember it was 50% debt, 50% equity. The initial market value of the project turned out to be $70.73 million. So half of that, 50%, had to be funded with in new debt. Okay, it's that simple. And they could add this debt either by reducing cash or by borrowing and increasing debt, right? So what they're going to do is, they had $20 million in cash, so they're going to spend the $20 million in cash, and they're just going to borrow an additional $15.365 million. So because again they only needed $29 million to fund the project, so they're going to use some of the extra money they're borrowing in debt, which is $6.365 million, to give to the shareholders through either a dividend or a share repurchase. Okay. So this is what the balance sheet looks like afterwards. The cash is gone. Here's the existing assets, right? Here's the RFX project. So now the total assets are $670.73 million. Of which 335, again, it's 50-50 is debt, and equal amount is equity. So this has got to be equal, right? This has got to be equal. It's a balance sheet. And the market value of the equity increased by $33.625 million. Here was the original equity. So you can see how much the equity increased. So adding the dividend of $6.365 million, the shareholders' total gain is $41.73 million, and that turns out to be exactly the net present value we calculated for the project. So you see how nice that worked out. So we're going to define what's called a debt capacity, and I'll highlight that, right? And debt capacity, by definition, is the amount of debt at a particular date that's required to maintain the firm's target debt-to-value ratio, right? That's the enterprise value, right? Debt to value. So the debt capacity at day T is simply what? The leveraged value of a project times the debt to value ratio, right? And that gives you the debt capacity, right? So here's the debt to value ratio, and that will give you the debt capacity right there. So it's a real simple equation. So here's how debt capacity is here's how we get debt capacity. And here's your free cash flow at time t plus 1. And hold on, there's something going on here with this equation. All right, so there's a big space here. And this here should be over here, right? I try to fix this, but let me see if I can fix this. I don't know. And so this is the free cash flow at time t plus 1. And here's the value of the free cash flow in year t plus 2 and beyond, which is just the valuation at t plus 1, right? And that's a 1 over the weighted average cost of capital. So this gives you the valuation at time t. All right, so this space is just nothing. And if you look in the book, this should be right there, okay? Okay, so here's the basically the debt capacity of the RFX project over time. Okay, so here's the free cash flows that we talked about. That was given. Okay, here's the levered value at the weighted average cost of capital of 7.25%. Okay, so we've got that here, right? And here's the debt capacity basically at 50%. So you can see we're taking 50% of this all the time, right? So this is so we're basically getting that levered value, and what we're using is this equation right here. All right, so let's look at the debt capacity for an acquisition. So suppose Avco proceeds with the acquisition described in example 18.1. How much debt must Avco use to finance the acquisition and still maintain its debt to value ratio? How much of the acquisition cost must be financed with equity? Okay. So how much debt? So they got to find out how much debt should they use and still maintain that debt to value, and then how much should be used with equity. Okay. So here's the solution. So they want to maintain a 50% debt to value ratio, right? And this is the how much it was acquired in the acquisition, 100 million, right? The leverage value. Excuse me. So they must increase their debt by 50 million because it's 50% of that. So the remaining 30 million of the 80 million acquisition cost will be financed with new equity. In addition to the 30 million in new equity, the value of Avco's existing shares will increase by the 20 million net present value, right? 100 million minus 80 million is the 20 million. So in total, the market's value of Avco's equity is going to go up by $50 million. Hope everyone's clear on that. So there's another example that you can go through here. It's an alternative example. All right, so now we look at method number 2 here to do valuation. And this is called the adjusted present value method. And this is going to differ from the weighted average cost of capital method. Okay. And it's used to determine the levered value of an investment. But first we got to calculate its unlevered value, right? You notice how we do that? We do the unlevered value here. And then we add the value of the interest tax shield. So this looks pretty simple, right? V levered, which is also the adjusted present value, is equal to the unlevered value plus the present value of the interest tax shield. So there's a couple steps involved. We have to calculate the value of the free cash flows, right? Using the project's cost of capital if it was financed, again, without leverage. So we got to do the without leverage part first. Okay, so the unlevered cost of capital, again, is right here. Everyone should see that, right? Notice there's no 1 minus the tax rate, right? This is RU, right? Completely unlevered, right? So this is pre-tax weighted average cost of capital. And then we'll do the interest tax shield separately. So this unlevered cost of capital equals its pre-tax weighted average cost of capital because it represents investors' required return for holding the entire firm, equity and debt, right? So we'll do it that way. Whoops, hold on, did I skip a slide? No, I'm good. Okay. So when a firm adjusts its debt proportionally to a project's value or its cash flows, and that's the target leverage ratio. So this is our target leverage ratio. And basically a constant market debt to equity ratio is just a simple special case of the target leverage ratio. So here's the unlevered cost of capital, which is quite easy to calculate. 50% as we were given, 50% debt and equity. And here's the required return, and here's the required return. So we know those numbers. So this comes out to simply 8%. So the value without leverage is, again, the cash flows divided by the unlevered. Now, we're just doing the unlevered part first, okay? We're just doing the unlevered part. So now the value of the 59.62 million. Hold on, I think do we have a mistake here again? Okay, there was another error in your book on the slides. So as you can see, I'll go back one slide. This was 69.55 that we calculated, and this had some other crazy number. So this is now fixed. I fixed it. So again, this is the unlevered project and doesn't include the value of the tax shield. Now here's the interest paid in 1 year, right? Here's the interest paid in 1 year, in year T. And that's the debt return times the multiplied by the corporate tax rate, and it's okay. So here's the corporate tax rate, okay. So this is the tax on the debt. So here's the debt capacity each year. And here's the interest. Here's if you take 6% of these numbers, take 6% of the debt right here, you'll get these numbers, right? Take 6% of that. Okay. And that's the interest paid. And then the interest tax shield at 25% will be 25% of these numbers. So this is the interest tax shield that will be used to get the levered portion, right? So that's what we need there. That gives us the levered portion. Okay, so now we got to get the present value of the interest tax shield, right? And the present value of the interest tax shield is, here's the debt capacity, right? Here's the debt capacity. And basically, here's the unlevered cost of capital. Okay, so let's go back and look here. Here's the interest tax shields we have, right? There's the tax shields that are important. And those go up here. We get the present value of the interest tax shield, and that gives us $1.18 million. So the total value of the project, again, is the unlevered and the levered portion, and here they are. And it gives us $70.73 million. So the net present value of the project is $41.73 million because I subtract off the $29 million initial investment, and that comes out to $41.73 million, and exactly the same value found using the weighted average cost of capital approach. Okay, so here's a summary of the APV method, right? And basically we determine the investment's value without leverage, and then we do the present tax shield, and then we basically determine the interest tax shield, and then we get the unlevered value added to the present value of the interest tax shield, and that gives us the value of the investment with leverage. Okay, so it's easy to apply. You can see how it's much simpler than the weighted average cost of capital if the company doesn't have a constant debt equity ratio. So that's the second method. So there's an example in your book here which you can go through. Right, and there's another alternative example. We will not do section 18.7, okay? So we will not do that. So I don't want anybody to get nervous about that. So don't worry about that. All right, so this is the third method. I'm going to include this in in part 2 because I'm about a half hour into this video, okay?
In this video, we're going to talk about something called the weighted average cost of capital, which is commonly abbreviated as WACC. So we're going to talk about what it is and how you would go about calculating it, and then we'll walk through an example. So when we think about WACC, this weighted average cost of capital, really what we've got is we've got the financing of the firm. So we've got a firm here. Now this firm is going to be financed from two primary sources. One is debt and one is equity. What does that mean? Well, the firm can get money from borrowing, or people can put up equity, shareholders or the owner themselves. So what we're thinking about here is we're looking at this mix of debt and equity, and then we're going to go ahead and basically calculate cost for each one. The cost of equity, that's the RE, and then the cost of debt after factoring in the tax considerations. And we're basically going to assign a cost to each one. But we have to weight these costs, right? Because we don't know how much of the mix this debt or the equity is. Okay, so the debt for the firm might be just 10% of its financing, whereas the equity is the other 90%. So we can't just go ahead and say we'll take a 50-50 split. So this is going to make more sense when we go through an example, but for right now, just let me walk you through this formula. So the weighted average cost of capital is equal to, we've got the firm's equity. Now, depending if you take finance, so you'll be using the market value of the firm's equity, and if you're taking an accounting course, it might just settle for the book value of equity. But in any case, we'll just call it equity here. The firm's equity divided by the total of the firm's debt and equity. Now, when we're talking about debt here, what we mean is interest-bearing debt. Interest-bearing. So we're not just talking about liabilities in general, which might include things like unearned revenue. We want to talk about interest-bearing debt, bonds that the firm has or something like that. So this is, right here, what we're trying to do is calculate that proportion of the firm that is being financed by equity. Okay, and then what we're going to do is once we've got that proportion, right, this share of the financing that is attributable to equity, we're going to multiply it by the cost of the firm's equity. right? That's what RE is commonly. This is the cost of equity. Let me just write that here. Cost of the firm's equity, right? And that'll be something like 8%, 9%, 15%. It depends on the firm. But the main idea here is that we have to figure out the proportion of the firm that is financed by equity and then multiply that by the cost associated with that equity. Now we've got, so this is all kind of one big component of WACC is the equity side, but now we've got the debt side, right? So debt is part of this financing of the firm. And so now we have to say, okay, well, we'll take a look at the firm's interest-bearing debt and then see what proportion that is of the debt plus equity. So what proportion is the debt of the firm's financing? And then we're going to multiply that by the cost of debt. Okay, this would be like the yield to maturity on the bonds or something like that. Maybe that's 6% yield to maturity. So the cost of the firm's debt, and then we're going to multiply that by 1 minus the tax rate. Now, why are we doing that? Because we have to remember that we want the after-tax cost of debt because there's a tax shield associated with interest. We'll have a different video on that, but just bear in mind that's why we're multiplying by 1 less the tax rate due to this tax shield. So basically, all we're really doing, we've got a big long equation here to calculate WACC, but all we're really doing is saying what is the proportion of the firm that is financed by equity and what's the proportion that is financed by debt. Okay, and then we're going to take those proportions, those weights, and then we're going to multiply them by the associated cost, the cost of equity and the cost of debt. So let's go ahead and let's work through an example, and I think that you'll find it to be a lot easier when we do that. So we've got an example here where you start a firm, and you start this firm by borrowing $2,000 from the bank, and that $2,000 the bank's going to charge you 6% interest, and then you put up some of your own money, some equity of $8,000. And then let's just say, this calculating the cost of equity is a whole nother video. You can use things like the capital asset pricing model. But right now, let's just say that that's 12.5% without getting into how that we actually calculate that. So then we say, well, we've got a tax rate of 40%. So now we can go ahead and we can just plug the numbers in to this formula that we have here, right? So in the interest of space, I'm going to try and do that down here right below our example. So let's just go through this step by step. So move down a little bit further. So the WACC, our weighted average cost of capital. See, we can't just take these two and say, okay, let's add those up and divide by 2, right? Why can't we do that? Well, because debt is only $2,000 of the financing and equity is $8,000, right? I hope you understand kind of the idea, the concept behind why we're doing this. So the WACC is going to be equal to, and we'll have, let's do the equity side first. So we've got $8,000 in equity, right? So to calculate the proportion of equity, we say 8,000 over 2,000 of debt plus 8,000 of equity. Why are we doing this? Well, look, we've got $8,000 in equity up here, but we know that the firm's total financing is both of these, right? It's 2,000 plus 8,000. So to get the proportion, we're taking 8,000 and then dividing it by that total. And basically what we're seeing here is that, we're going to have 0.8 or 80% or however we want to think of it. The financing is coming from this equity source. But now we have to multiply this by the cost of equity, which is 12.5%, which is the same as 0.125. All right, so now we've got kind of the equity component here. Change colors, and now we have to add in the cost, the weighted average cost of this debt here. So now we're going to go and basically do something very similar. Just take now the 2,000, which is this debt, but now we have to weight that. We have to take the proportion of that. So now that's 2,000 over 2,000 plus 8,000. Okay. Now we're going to multiply that by the cost of debt. That's 6%. So that's the same as 0.06. But now we have to factor in that after-tax cost of debt. So what we're going to have is 1 minus the tax rate, 1 minus t, which is 1 minus 0.4. T is just the tax rate. And so now we've got this big long equation, but let me just save you the math here. So our WACC, if we take this whole piece right here, what that comes out to is 0.0072. Okay, and now this piece over here, if we calculate that, this piece here, this first piece is actually 0.1. So this is 0.1. Apologize there. And then this piece is 0.0072. So we add these together, and it's 0.1072. And that is equivalent to, and we think about a percentage, so a little easier conceptually, 10.72%. So the weighted average cost of capital for this firm that we've started here is 10.72%. Now let's go back here for a minute. Now if you calculate and you say, okay, let's add up 6% and 12.5%, and let's just say, we'll divide it by 2 and get the cost of capital. Well, what you're doing is now you're just getting, we can call it the average cost of capital, right? Because you're just taking two different costs of capital, the debt cost and the equity cost, and you're just saying let's just divide that by 2. Let's just average it. But we're not taking just the average, because we recognize that there are different weights that should be assigned here, because 80% of our firm is actually being financed by equity. So more weight is being given to the equity component of our cost of capital, and that's why we call it the weighted average cost of capital.